And joining me now is Jason Horn from Steyn Capital Management to share his analysis on the day's market performance. Jason, thanks so much for your time this afternoon. Now, investors, as mentioned, awaiting those U.S. inflation figures following softer PPI numbers that we got yesterday. Do the factory prices give you some confidence when it comes to consumer prices, especially as we are starting to see a lot of these firms, these businesses, really stomaching those tariff costs?
Yes, I think if we look historically at correlation between PPI and CPI are not that strong. I think what you alluded to there, it does seem like at this stage with the tariffs, the producers have been stomaching most of that, so obviously you will start to see some margin compression and the like. But yeah, correct. It does seem like on the PPI yesterday, it was a bit of a shock number, and I mean we saw that immediate reaction in the US equity markets as well as the bond market, almost guaranteeing pricing in a 25 basis point rate cut for next week, and I mean we're already starting to see some chatter around 50 basis point rate cuts next week.
I mean, we can only hope for that 50 basis point cut to come through, right? So while we are talking about monetary policy and how inflation is likely to influence the Fed's next move, across the Atlantic, we also have the ECB meeting today. Just your expectations on that front. I mean, many economists are expecting a hold from policymakers in Europe.
That is correct. If we look at Europe versus the US, slightly different picture. I mean, we've had a relatively dovish ECB for the last year or so. However, if we look at inflation expectations are still fairly low, hovering in and around 2%. And then on the other side, we've started to see some more resilient economic data come through. I mean, if we look at the likes of PMIs over the last quarter, have been increasing above 51 now. So it does seem like we might see a somewhat more hawkish tilt to the ECB, but more than likely, yes, a hold this time around, and more than likely another probably 25 basis point rate cut come December in Europe.
And I can imagine how difficult it is for policymakers out in Europe to navigate monetary policy, considering how unbalanced growth is across the region.
Absolutely. I mean, we did see a bit of a growth surprise for Q2 in Europe, 0.7% GDP growth. But at the same time, you've got to try and take into account now what is the impact of these tariffs going to be, and the trade deal that needs to be ratified between the EU and the US, and what that impact is going to be. So I think from that perspective, risk certainly is to probably the downside from an inflation perspective, kind of thinking the demand side of the equation. So the tariffs are more than likely going to lower demand. And then we've also got to bear in mind that the euro has been exceptionally strong this year versus the dollar. I mean, if you think of what DXY has done, one needs to bear in mind that is majority of that index is the euro. So you've also at the same time, yes, you've got all this uncertainty around trade with the US and Europe, but you've also got the exports getting more expensive as the dollar continues to weaken. So that is definitely going to weigh on growth prospects for Europe. And it's definitely something they need to think about, and that is more than likely why we will continue to see this dovish leaning from policymakers in Europe.
All right, let's bring it back home. Earnings season still in full swing. FirstRand posting a 10% rise in profits. The local businesses doing most of the heavy lifting, but it's also sets aside more for that UK probe that involves its vehicle finance unit on that front. Is there something we should be concerned about? I mean, about a month or two ago, it seemed like the lender scored a win on that end.
Correct, it did. I think they're going to continue provisioning as we've seen. But looking at this, the market reaction to the results and the commentary out of FirstRand, I mean, the outlook statement is quite punchy. And look, I mean, I think I mentioned this 2 weeks ago. I mean, FirstRand is arguably the highest quality bank in South Africa. I mean, yes, normalized profits were probably light versus market expectations, but yeah, it's in line with management guidance. The dividend was a beat versus consensus. ROEs remain robust at north of 20%. So this is super high quality business. And even including the additional provisioning we've seen, the likes of cost income ratios continue to improve. And yeah, all things considered, yeah, the local business is doing really well. And in spite of this uncertainty around the UK business, it continues to perform excellently. And yeah, based on share price reaction today, the market tends to agree.
Up 6.7% as we speak, Jason. From one quality business to another, Discovery, earnings there up 30%. Interestingly, Discovery turned a profit ahead of schedule. New clients up 30%. It's been doing quite good on that banking front as well.
Yes, I think broadly speaking, results are in line with the expectations. But yeah, I think the market probably got ahead of itself post the trading statement last week. It did run quite hard, so we are seeing it give back quite a bit this morning. But yeah, correct. I mean, the bank is performing well ahead of its plan, and yeah, by and large, all other parts of the business do seem to be performing quite well. It's just the trading statement was quite punchy, and the investors are just taking a good hard look at this and thinking, okay, well, let's assess our options here going forward.
All right, taking a breather, hitting pause for a moment there. And we're about to hit pause on our conversation before we move on to your stock pick. Let's take a moment to touch on what counters your industry peers are watching closely.
What impressed me was the numbers on, this is a Johnny come lately into cloud. And they kind of muscle their way in, but have done incredibly. Why I like it is that it just shows you, it gives you some see-through into this business, into the cloud business and how much people are paying, for data and so on. And that's, in a nutshell, that's what I like about it. And I'm just worried about where it's going to open, from that point of view. So the recommendation comes with a health warning, but don't ignore it. Don't push it aside. Yeah.
I call it simple. It's safe. Now, I think it's been one of my stocks. Let's call it a month or two ago. As one of my stock picks. It's done phenomenal since then. Results out, as you mentioned today. The results look pretty stable. I mean, that's good for a property stock. The outlook is looking good for the V&A waterfront, but they're still trading at a 28% discount to NAV. And why that's important. Although I don't think we'll see that massive premiums that we've seen 2010, 2011. It's 28% discount to NAV. I still think it's a little bit too deep. Mixed into the let's call it that recipe, a 9.5% expected dividend yield or interest yield. I mean, I do think it's still a nice company to have in your portfolio. Results were fine, and definitely something I'll still be holding.
So Skalk going with local counter Growth Point, and David picking what's been really boosting tech stocks over the past week, Oracle. Do you like these stocks, Jason?
Yeah, look, maybe the quick one to start with Oracle. I mean, as emerging and frontier market experts, not one in our wheelhouse, but yes, a very serious move yesterday. I mean, that's all on the back of the cloud computing and an extremely bullish outlook. I mean, I would say tread with caution with this one. It's always difficult to maybe forecast 2 to 3 quarters out in the tech space, but this is all on the back of a 5-year outlook, which, so maybe just tread with caution on that one. And then on the Growth Point front, look, it has a very diverse portfolio in South Africa, Australia, and elsewhere, but we don't think it's the best. I mean, while it's been reducing its problem office properties, still there's quite a way to go, and many of these properties are still suffering from those negative reversions.
All right, so what are you liking? What's your stock pick?
Not one that we necessarily like. It's actually, we're pitching a short today, which is PopMart. It's the Chinese collectible toy maker. Currently trading at around 50 times PE, maybe 37 times on a forward basis on a very optimistic view. And the market is expecting this growth to continue. I mean, we believe the main driver of the growth has been the Labubu fad.
Do you own a Labubu, Jason?
Look, I mean, the interest in the product is plummeting. It's 50% below its peak in July and continues to fall. And we're seeing secondary market prices fall as well. So, I mean, we believe the recent strength in the sales of their other toys is driven by consumers going to the stores to buy Labubu and then settling for other products as Labubu sold out. And look, I mean, the same happened with the Cabbage Patch craze in the 80s, and we are starting to see the stock price roll over as a result of this. So, yeah, one to watch quite carefully.
All right, let's leave it there. Jason, thanks so much for your time today. That was Jason Horn from Steyn Capital Management.